Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Now that you know what tips are, let's talk about how to invest in them and some strategies to help you get the best returns. Ready? Let's get started. Tips create a unique tax headache. Phantom income. Even though you don't receive inflation-adjusted principal increases in cash until maturity, the IRS taxes them annually. Imagine owing taxes on money you haven't actually touched yet. Here's how it works. Each year, the Treasury adjusts your TIPS principal upward if inflation rises. You're taxed on that gain as ordinary income despite no cash payout. At maturity, you receive the adjusted principal, but you've already paid taxes on portions of it over the years. Who feels this most? Investors in higher tax brackets or those holding TIPS in taxable accounts. Tax-deferred accounts like IRAs can sidestep this issue, but it's a key factor to weigh. Deflation risk. TIPS have a defensive feature, the deflation guarantee. If prices fall, your principal adjusts downward, but never dips below the original investment. Sounds safe, right? The catch. Your returns could still lag. In deflationary periods, your principal shrinks, but not below par, reducing interest payments. At maturity, you get the original principal back. No more, no less. Other bonds might outperform TIPS during prolonged deflation since their fixed payouts aren't eroded by falling prices. Example scenario. If deflation drops the CPI by 3%, a $1,000 TIPS adjusts to $970. Your interest payments are now based on that lower amount. When the bond matures, you're repaid $1,000, but you effectively had lower income along the way. Other downsides to watch: lower yields. TIPS typically offer lower interest rates than nominal treasuries because the inflation adjustment adds value elsewhere. If inflation stays tame, you might earn less than with traditional bonds. Interest rate sensitivity. Like all bonds, TIPS lose market value when rates rise. Their long maturities, especially 10 or 30-year terms, amplify this effect. Complexity. Adjusting principal and interest calculations can confuse investors used to simpler bonds. Automated tracking, like Treasury Direct's tools, helps, but it's an extra step. Bottom line. TIPS are powerful inflation fighters, but they demand a closer look at taxes, deflation scenarios, and trade-offs versus conventional bonds. Pairing them with other assets can soften these drawbacks. How to invest in TIPS. Getting started with TIPS is easier than you might think. Whether you prefer buying directly from the Treasury or through funds, there's a method that fits your style. Below, we'll walk through the two main ways to invest: direct purchases and fund-based strategies. Direct purchase from the U.S. Treasury. Buying TIPS straight from the Treasury is the most straightforward way to own them. Here's how to do it. Open a Treasury Direct account. This free online platform is the only place to buy TIPS directly. Sign up takes about 10 minutes, requiring your Social Security number, email, and a linked bank account. Check auction schedules. TIPS are sold at regular auctions, typically held monthly for 5-year and 10-year terms and quarterly for 30-year terms. The Treasury publishes dates in advance. Place your bid. You can buy TIPS in increments of $100 with a $100 minimum. Non-competitive bids, the most common, guarantee you'll get the bond at the set auction price. Hold or sell. After purchase, TIPS stay in your Treasury Direct account. You can hold them to maturity or sell them early in the secondary market through a brokerage. Why buy direct? You avoid management fees and get full control. But remember, you'll need to handle taxes on inflation adjustments manually. Investing through TIPS, funds, and ETFs. Not interested in managing individual bonds? Funds and ETFs offer a hands-off approach. Here's how they compare. Pros of funds, ETFs. Instant diversification. A single fund holds multiple tips with varying maturities. Liquidity. ETFs trade like stocks, making buying and selling simple. Lower effort. No need to track auctions or inflation adjustments. Cons of funds like ETFs. Fees. Even low-cost ETFs charge expense ratios, typically 0.03% to 0.23%. No principal guarantee. Funds fluctuate in value daily, unlike individual tips held to maturity. Popular options. Vanguard Inflation Protected Securities Fund. Mutual fund with a 0.20% fee. iShares Tips Bond ETF. ETF with a 0.19% expense ratio. Brokerage accounts. Most major brokerages, Fidelity, Schwab, etc., offer these funds. Minimums vary. Some ETFs can be bought for the price of one share, while mutual funds may require $1,000 plus upfront. Which is right for you? If you want simplicity and liquidity, funds win. If you're after the lowest cost and full control, go direct. Either way, you're adding a layer of inflation protection to your portfolio. Tips versus other inflation hedges. Tips aren't the only way to guard against inflation. Other options like EI bonds, traditional bonds, and real estate also claim to protect your money. But how do they stack up against tips? Let's compare the key differences so you can choose wisely. Tips versus I bonds. Flexibility and adjustments. Both tips and I bonds adjust for inflation, but their structures differ in ways that matter for investors. Here's what sets them apart. Liquidity. Tips can be bought and sold anytime in the secondary market, but prices fluctuate. I bonds must be held for at least 1 year, and cashing them before 5 years forfeits 3 months of interest. Purchase limits. Tips. No annual limits. Buy as much as you want at Treasury auctions. I bonds. Max purchase of $10,000 per year, plus $5,000 through tax refunds. Inflation adjustments. Tips. Principal adjusts monthly based on CPI. Interest payments rise or fall with these changes. I bonds. Combine a fixed rate with a twice-yearly inflation rate adjustment applied to the total value, principal plus interest. Who wins? If you need liquidity and larger investments, tips are better. I bonds suit smaller, long-term savers who don't mind the holding period. Tips versus traditional bonds. How inflation changes the game. Nominal bonds pay fixed interest, but inflation can erode their real returns. Tips avoid this trap. Here's why they often outperform when prices rise. Interest payments. Traditional bonds. Fixed payout loses buying power if inflation spikes. A 3% yield becomes worthless if inflation hits 8%. Tips. Payments grow with inflation. Even if CPI jumps, your income keeps pace. Principal protection. Traditional bonds. Repay the original principal at maturity, which could be worth much less due to inflation. Tips. Return the inflation-adjusted principal, preserving your purchasing power. Example. A $10,000 traditional bond pays $300 yearly. After 10 years at 4% inflation, that $300 buys half as much. A 10-year TIPS pays less upfront, say after 1%, but the principal grows yearly. Your final payout might be $15,000, adjusted for inflation, plus higher interest over time. Bottom line? In high inflation periods, TIPS beat traditional bonds, but if inflation stays low, nominal bonds might offer better yields. TIPS versus commodities and real estate. Gold and property are classic inflation hedges, but they come with trade-offs. Commodities equals gold, oil, Pros: historically rise with inflation, no counterparty risk. Cons: no yield. You profit only if prices go up, volatile and hard to time. Real estate. Pros: rents and property values often climb with inflation, tangible asset. Cons: high transaction costs, illiquidity, and maintenance hassles. Where tips shine. Predictability. Adjustments are automatic, tied to CPI. Stability. No storage costs or tenants to manage. Safety. Backed by the U.S. government, tips won't make you rich overnight, but they're a low-hassle way to stay ahead of inflation without betting on markets or maintenance. Still unsure? Think about your goals. If you want pure inflation protection with zero guesswork, tips are hard to beat. If you're okay with risk for higher potential rewards, commodities or real estate might play a role. Just know the trade-offs. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.